Great to be here. Thanks to all of you for joining us. So I'm pleased to be joined by Nima Ghamsari of Blend, Regis Hadiaris of Quicken, and last but not least, Michael Tannenbaum of SoFi.
Thank you.
Great to be here with you guys.
Great to be here.
So a lot of interesting things going on in the mortgage market right now, and I think the panel here kind of speaks for itself when this is a mortgage panel and there isn't one bank here. And that is very indicative of where we are headed. Non-banks recently took over banks in terms of the share of mortgage dollars being originated. Quicken Loans is no stranger to this. You guys are number 3 in the mortgage market based on mortgage origination volume. Number 1 when it comes to some of the government programs like FHA. So I start with you, Regis. What do non-banks have to offer that banks can't or don't want to offer?
Well, I think first of all, I think the term non-bank is sort of an interesting term because if we think about what we're really talking about, it's do you take deposits or not? And I don't think really taking deposits really is an indicator of how well you could lend money. So if we think about Quicken Loans as a mortgage lender, you're right, we did $96 billion last year in mortgages, $7 billion in our first year in market with Rocket Mortgage. And the reason for, I think, the growth that we've seen in direct-to-consumer mortgage lending is because you've got companies that are focused just on the mortgage experience. We're focused on taking that experience and removing the friction from it, finding ways to deliver tools to clients that let them make good decisions on using the technology that's available. And that's what we see with Rocket Mortgage, and that's what we see people doing today.
So I'm going to get into the friction part of it in a moment, but before we go there, with any development, there's always pros and cons, risks and advantages that are introduced into the market. And so one of the bigger risks being talked about as non-banks take over is you guys don't have deposits, and so what happens in the event of another sort of severe economic downturn? Will non-banks have the liquidity to keep operations running? That's been voiced by the former head of Ginnie Mae. That's been a concern raised by Moody's. So Regis, I'll just start with you on that again because you guys are so big in the market.
Sure, I think there's really 2 things to think about there. It's really about regulation and capitalization. And if you think about regulation, as a mortgage lender, often we're subject to regulations that even banks aren't because they have federal preemption rules. So we have to be licensed in every state we operate in, all 50 states, and different states have different requirements. And so not only do we have the state regulation and federal, we've got Fannie Mae, Freddie Mac, FHA, VA, Ginnie Mae, the CFPB, a wide variety of things to comply with. So I would say when we talk about risk, really anybody who's providing a mortgage is sharing the risk of lending to a consumer. So then it really becomes capitalization. And I think that story really needs to be focused on the capitalization of different companies. For example, the parent company of Quicken Loans has assets greater than 93% of all FDIC insured institutions. So really, I think it's much more about regulation and adhering to that, and then capitalization and how well capitalized a lender is.
So those are fair points. I mean, one of the things that is brought up a lot in this conversation about the liquidity risk focused a lot on some of the smaller lenders in the space, whether they have enough liquidity. By no means is SoFi a small lender.
It's okay, pick on the small guy.
But one of the things that I've been thinking about in terms of this risk is you guys recently bought Zenbanks.
Right.
And so there's just some questions there about what is the goal here? Does this acquisition potentially mean that you could be lending against deposits down the road?
Sure, I mean, I think that is what it means. Zenbanks was not a bank, despite it's B-A-N-X, so not quite a bank. But it was a technology platform on top of a bank. And I think what it allows us to do, I mean, it's been pretty public that we've applied for a bank charter, and I think the technology that we purchased was instrumental in that application. And then it also allows us to have a deposit. In the event we don't receive that charter, it still allows us to have a deposit offering where we would work with a sponsor bank to offer FDIC insured deposits to our customers. So I'd think about it more as a customer strategy rather than a funding strategy. SoFi's always been about serving a customer base, and while its funding strategy has allowed it to better serve that customer base, we lead with that strategy first, and then we figure out how we can most effectively fund what we're trying to do, and that makes the product the best product it can be.
So you mentioned the process of applying to become, what is it, a bank, like a bank?
So I know that what we applied for is called an industrial loan charter, which is a type of bank.
And so there's been some friction there, which has been playing out in the public eye recently.
SoFi is no stranger to friction, as you know.
Yeah, well, the banks aren't really pleased. At least some of their reps in the industry aren't. Your CEO and the head of the CBA, for example, have been going back and forth recently. Quite entertaining, but it touches on this question of, the friction that's playing out right now on several levels as mortgages, for example, are becoming more digitized, that some banks aren't pleased. And this is one example of that. So what is SoFi's take on that? Like, do you just not care? Like, too bad for them, we're taking share?
No, I mean, I think look, when you have, we're talking about fintech at this conference, it's part of the broader tech, which one of the mantras is disruption. All the three companies on the stage today represent a version of disruption, which means changes in market share, changes in jobs, changes in outlook, changes in equity capitalization of companies. So there's always going to be winners and losers in an economy, but I think it's certainly too strong to say SoFi doesn't care about, what its impact is on the community. If you actually read the application, and I know you weren't implying that, but if you read what the application, there's specific plans for us to participate in the community in Utah where the bank is chartered. I think there's certainly a concern that we're being a good corporate citizen and a good citizen of financial institutions broadly in the country. I think SoFi maintains that we're serving a customer that's not being either adequately or served at all by the existing financial services ecosystem, and that's why we exist.
And that dovetails nicely into the fact that you guys do have a customer base that a lot of the banks are eagerly trying to attract. Some are not doing such a good job at it. I mean, SoFi obviously at its core started out refinancing student loans, being in the student loan market essentially. That's allowed you guys to get a lot of young adults, what you guys have dubbed as Henrys, where the goal here, as it appears to be playing out, is you get them with student loans and then you get them to get mortgages, right? So talk to me about the marketing strategy on that front, how that's all working out. You have all this, data on these people and you're marketing mortgages to them. How do the two things come together?
And I think when you talk about SoFi and you talk about student loans, it's almost like you just take that for granted, but you have to remember that student loan is a new phenomenon, right? The idea of having tons of student debt is new to this generation. That's why SoFi is relevant. That's why the banks previously were not focused on it. It's a newer concept as education has gotten increasingly expensive. And so as we've acquired those customers, which again, that's also taken for granted, but now at this point we're doing, almost $600 million a month of student loan refinance. So we're acquiring lots of customers and we know a lot about them from their financial picture, where they work, their income, we know activity in their checking accounts. So there's lots of data that we have, and we know that they're typically not homeowners, but as they pay off their student loans, as they attend offline community events hosted by SoFi, where they learn about home ownership, and as their income grows, we know that they're looking for homes, and I think that's where SoFi is well set up to offer a mortgage product, and that's where we are. That's sort of our go-to-market strategy.
And how do you do it? I mean, do you have all these young adults as your existing borrowers? Are you sending them solicitations by email, by text, how are you finding them? And I'm assuming you're not waiting for them to come to you and say, oh, hey, we want a mortgage, but rather you must be taking that.
Yeah, I mean, we talk about something internally called rich contextual outreach. So if anyone was in the audience from SoFi, they'd laugh because we say it so often. But the idea is to not present somebody with oh, by the way, did you know SoFi offers mortgages in your state, but you saved $231 a month on your student loan when you were 28, you went to Stanford, and peers at Stanford have been buying homes in this zip code with this mortgage product 7-1 whatever it is. So trying to make sure we know your. Oftentimes also student loan customers identify by their profession. What did you do to get your student loan? And so whether it's your school or your profession or where you live or when you became a customer, how much you saved, those are the data points we're using for outreach.
So Nima, I want to get to you. So you've been very obviously involved on the technology side of all of this. And so really, I mean, at this point, as I think about mortgages and just the movement online, I just think about, in this day and age, you can get a credit card, you can get a personal loan very quickly. Why is that still not the case with mortgages?
I mean, first of all, I think part of it is the fact that the mortgage itself has a property, a house behind it, and that has to be verified. But I think also the mortgage process is you have to verify the person's assets, and they might have 3 or 4 asset accounts or more. You have to verify that person's income. You're required by law to do these things in a lot of cases. You have to verify their credit history, that they can repay this, and essentially you want to figure out if they can repay it. And doing that, I think the title of this panel is Reimagining the Mortgage Market. I think all of the technology in the space is geared at doing those things in a different way than it was before. And so the old way was, as a consumer, if I was applying for a mortgage and you were my bank, I would go to you and you'd, at first, day one, you'd ask me, how much money do you make and how much money do you have? And you'd fill it in on some form. Day 8, you'd ask me to provide some supporting documentation, pay stubs, W-2s, bank statements from all the different accounts that I have, enough to cover the loan. And then day 15, you might go and call my employer and ask them for a proof of verification. And you've taken a pretty, to be fair, it's a lot of money changing hands.
Sure.
So it's important to get it right, but you've taken that process and you've made it very manual. And the reason that you've made it manual as a bank is that, fundamentally, historically, the technology wasn't there and the data infrastructure wasn't there to answer those questions in real time about your creditworthiness, how much assets you have, how much income you have, your credit history. Some of that was there, most of it wasn't. And so you had to do it this old way. What I think is happening now is that there's enough data infrastructure out there that in the push of a button, the consumer can authorize the bank or whoever it is to go and get your financial data with your permission, my financial data with my permission, aggregate it. It's machine-readable data, so it can run directly against their underwriting models, and it's verified. And that means that all of the friction in the transaction of understanding my financial picture is going to zero. Now, there's still psychological barriers to getting a mortgage. It's a really important life decision. You don't want to be, getting mortgages, literally with one button every day. You want to make sure.
Push button, get mortgage.
Push button, get
I
mortgage.
heard that somewhere.
No, I think everyone would agree that there are psychological barriers, but you want to make it so easy that there's enough information that you can pull together so that the consumer isn't waiting and doing this onerous process. And it's expensive for the consumer, it's expensive for the bank, it's expensive for, it's opaque to the investor who can't see that data because it wasn't machine readable before. And so everybody in the chain loses without good technology.
So I can't not get to you with all that we're discussing right now. I mean, this is what Quicken Loans is known for, right? Rocket Mortgage, you press a button, you have a mortgage, but you still can't do it all online. I mean, the ads somewhat suggest that, but there's still several steps in this process that seem to have a long way to go. What can you do quickly as a consumer working with Quicken in the mortgage process, and what can you still not do quickly?
Sure, absolutely. So I think what Nima touched on makes a lot of sense. If we think about the experience, it's really about how do we get to know a consumer and their goals as quickly as possible, and then understand the property, income, assets, and credit they have so we can offer solutions online. And so instead of taking people through long questionnaires and trying to figure this stuff out now, we can use a lot of data. We can import property data from most properties in the United States. We can import their bank account information and analyze it and do digital verifications of assets and income on the spot. Same with credit. So we can get people to solutions they can get a lot faster, within minutes, today, online, on a mobile device, 24 hours a day, 7 days a week. And we're offering that up Today, roughly on average, every 60 seconds, we're offering one of those customized mortgage solutions. So the days of these teaser rates online that aren't really what a person can get, and then they have to like figure out what they can get by taking a bunch of time out of their day, those days are over. And they're able to do a lot more research on their own. So that's a good thing. They can click a button to get approved to, through Fannie Mae, Freddie Mac, FHA, VA. They can lock their interest rate, e-sign their mortgage applications. All those spots and points have been automated. Typically, there is still an appraisal. And so someone has to go to a property, inspect it, do a comparables analysis, and that sort of thing. We still have that part in the process. And then when we think about the closing, there's still typically signing papers today for the most part. And a lot of that is because the e-notarization component, where I could be standing in one state on a device and maybe closing with a lender in a different state on a property, maybe even in a third state, those rules are still getting put in place and that technology is still getting built. So I think we'll get to a day where we see that, and I think that day will come quickly. But when it comes to the experience today, one last point, we're seeing people go through fast. The industry averages are 45 days. We've seen our fastest clients in Rocket Mortgage go from creating an account in Rocket to signing on those closing papers in 9 days in a refi and in 16 days on a purchase.
So 16 days from start to finish,
Yeah.
You've had clients get a mortgage. They literally start the application with you guys,
Yep.
and then 16 days later, they have it.
Yep.
They're at closing.
Yes, absolutely. And that's
Is that an
that's
exception
great.
right now, or is that becoming more common? How common is that right now?
I would say the average for all of our clients is less than 30 days. And then
You're
some
still
of those
dealing
are our
with the realtor,
fastest.
right? I mean, there's two parties to a purchase transaction.
Sure.
So someone's got to get out of the house, and someone's got to, right? There's a
can
real
only
estate
move so fast.
Right,
That's
and
what
real
he's
estate
saying.
contracts have, as he just said, you got to have somebody come in. They look under the stuff. So I mean, they take pictures. That takes time. So it can't go much faster.
Right.
faster
Well, because
Right.
that gets to the point of that. Obviously, these transactions are way more complicated. You have, as you mentioned, the appraisal. Have there been efforts to try to digitize that somehow, like to basically remove the actual person
Fannie Mae
going
is
to the
doing that.
homes? How widely used is that for you guys, with Michael?
I mean, so that's one thing I'd say is, not to plug a fourth party, but Fannie Mae has been is pretty innovative in technology, I would say, and they have what's known as a property inspection waiver. So if they've already seen that property or property nearby that's similar, they will waive the appraisal requirements in certain instances. So there are some lenders, I'm assuming Rocket Mortgage or Quicken is among them, that supports that product. We certainly do at SoFi. So if we get that notification that there's a waiver, we will go ahead and not require an appraisal.
And I think the bigger picture on that is that as that data gets better about properties,
Yeah, more and more.
and property comparables, and as that data gets better and better, and if it's properties that there is data about, as that data set gets better overall, we can all build experiences on top of it that make it easier and clearer for the consumer.
What are the biggest weaknesses in the data right now? So we talked about the data that's available easily online, right? But data is not error-proof. So what are the biggest weaknesses right now?
I mean, the data infrastructure is evolving quickly, but it does have some gaps. I think the breadth and depth of income verification data is not as good as it could be. It's still improving. I know there's some bills on Congress to improve the way the IRS, makes that available to the consumer, right? It's not about making it available to the bank. It's for the consumer to get that and send that over. It's not a trivial task for them. And so I think there's a lot around that. And then just to kind of close the loop, your original question was, why is it so much easier to get these other products?
Right.
And I think that the fundamental reason is that I think all of those products long-term should, if we made it so that it was completely frictionless to get this information, with the consumer's consent, of course, then all those other products would use this information too, because you want to understand the customer before you give them a $45,000 auto loan too, right? Like you want to understand and be sure that they can pay you back, because you don't want them making a decision that they can't afford either. It's kind of a two-party thing. And then eventually, as we get the friction down to zero, I think it would kind of end up with, what Michael said, where the things that are stopping the transaction are not getting paperwork back and forth. It's going to be, am I ready to move out of this house that I've lived in for 10 years and let the new mortgagee, move into this house? And so those are the things that I think will become and those are the psychological things that are not, what's the right product for me? Do I want a 7-1? Am I going to move? Do I want a 5-1?
Love a 7-1. It's my favorite.
Yeah, I love the 7. I just got a 7-1.
California people like 7-1. That's just how we do.
Because you're staying in the home, probably not for a longer period
Younger
than
people
that.
and people with higher payments like 7-1s.
Right.
Because they're not staying and because the payment's lower.
Yeah.
For the time being. I mean,
the time
the arms
For 7
discussion
years.
is a very interesting
Well, look, it used to
one.
be a risky product. I mean, the GSEs don't support it. So I think for the right demographic, it makes a lot of sense. For someone who can't afford the fully amortizing payment, it makes no sense. So it depends. But also, we've been in a flat, low-rate environment
Right.
for over 7 years. So people that got 7-1s in 2009 floated down.
Right, no, you're doing pretty well if you got an
Right, and look,
arm,
it will
right.
look real. Look, maybe you'll be looking at me in 5 years laughing and saying, "Ha ha, you're stuck with that crappy 7-1."
Well, one of the things that I
Then,
found...
as you know, in mortgage, you can always refi. That's the.
Well, sure. I mean, one of the things I found really interesting as we're talking about the low-rate environment is after the election, when there was the spike in rates, pretty quickly after that,
Oh, that was a big deal.
As applications started to dry up, hearing from at least the big banks that they were already having those sharpening, let's say, those discussions to have with would-be borrowers about consider the arm. And yes, there's ways to sort of work your way around that, but it's still risky, right? I mean, you could say you're going to stay in the home for 7 years, I'll get a 7-1 or a 10-1, but nobody really knows what the market's going to be like. So arms are still a pretty small part of the market, but
That's right.
it'll be interesting to see where that goes once rates really do start to pick up.
I think it's interesting too, as we provide these tools where clients can really get insight into what their options are and compare and contrast. We offer term options from 8 to 30 years and different pricing options
8
within
years.
that. So there's people who, if they're refinancing.
The world takes all types, I guess.
That's right. If someone's refinancing and they don't want to go back to a 30-year and they've been in a house 6 years, they can get a 24-year mortgage, right? And
So you customize basically the repayment.
they can customize it themselves in Rocket Mortgage. And I think the point of that is that there are tools now that people are only starting to become aware of like this, where they can really see what their options are. I talk to people all the time who are still in interest rates that they shouldn't be in. Regardless, they could get a fixed rate mortgage a lot less than the interest rate they're in. The perception is it's painful, it's confusing, it's complicated, it's scary. I don't want that pain in my life, so I'm just not going to do it. When really they could be making a better financial decision using the tools that are available now.
So the low rate environment has obviously been very favorable for mortgage lenders, but especially so for non-banks. Refis tend to account for a greater share of the mortgage volume coming out of the non-banks. And so how are you guys preparing for whenever it is that we reach the point where we're not, at near record low rates? I mean, everybody keeps saying it's coming. I mean, who knows when that will be, right? But you must have some groundwork.
Yeah, I have 2 words for that, Rocket Mortgage. So 2/3
So
of...
promotional.
No, but seriously, 2/3 of people who open accounts in Rocket are buying a home. They're not refinancing. And half of those are millennials. So we're seeing people come into market to buy homes that weren't before. And I think that's one signal. The other, and we see the movement. Last year when Brexit, the announcement and vote happened, rates dipped.
Plunged.
Huge influx of people coming to Rocket to refi. When rates have ticked up at the end of last year and early this year, we see the move to cash out. So we see those consumer behaviors playing out in real time as the market shifts.
So one of the other areas that has been a point of friction between the non-banks and the banks has been just related to scraping, right? So obviously a lot of what's going on.
Hot topic.
Hot topic, right? A lot of what's going on.
That's his area more.
I think that's all of your areas
Yeah, sure.
to a certain extent. Don't just point the finger at Nima. But I mean, in order to get this data so quickly, that is part of what's involved, right? And so the banks aren't pleased with a number of different companies just being able to go in and grab that data. There's been a lot of sort of back and forth on that.
But like Nima said, it's their data. It's consumer data, right?
It's consumer data that rests with the banks, and maybe it's just the banks are pissed off and they're trying to find different ways to kind of stick it to the non-banks, but it is something that they've been making noise about, and to the regulators as well. So let's talk about that, Regis.
Sure. So I think the narrative in the media actually is a little bit off. And what I've seen in my interactions and working in the industry is the banks aren't being bad actors. They're custodians of their clients' data, and so they're trying to figure out the right ways to do this. I think the bottom line is that they want the ability to import their clients' accounts from other financial institutions too, because then they have a better picture of a client's full financial life and can make better decisions. So I think what it really comes down to is FIs, data aggregators.
Skeptical.
They really have more to, I'm not sure, right? I mean, if you're the primary checking account of your customer, you'd have to ask, are they already using the data, which they should be, and I think we know the answer is typically not, but some are. Some of the banks will make in-funnel credit card offers, or they'll be able to underwrite. But one of the things that SoFi is, the premise of SoFi has been that if you're a customer of Bank A, I won't pick on one, and you're a checking account customer, you go to apply for a mortgage at Bank A, you're starting by writing your name down again, right? You're writing your social again. You're writing your address. So they're not necessarily talking to each other. So I feel that they maybe have more to lose by allowing access to the data. I agree, I don't think it's as contentious as maybe the media makes it, but at the same time, I would imagine if I was running a bank, I would not be indifferent about the idea of other financial companies coming and grabbing that. I would prefer they didn't.
Well, I think as an industry, we have an opportunity to really rally around this. The FIs, the data aggregators, the fintech companies, the mortgage lenders, and create a standard by which you connect things to your bank account.
And are you guys working on that? What are you doing?
We are, because I think that there's a lot that can be done there, that if the industry comes together and does that in a really solid way, it just makes it better for every American.
So tell us, what are you doing to try to create that standard, and who's involved? And
Well,
is this a Quicken only? It doesn't sound like it's a Quicken only thing.
No, there's a lot of folks in the industry right now getting together with this similar idea of, if you think about even just like something completely different, you think about wireless connectivity. You see the Bluetooth icon, you know that, oh, I can connect my wireless headset or whatever, my watch, to this device. We need a standard like that for connecting different applications to a bank account. And so that's really where the focus is starting to go.
And are the non-banks working with the banks to do that?
They're
or is
working
this-
with vendor. I mean, there's technology vendors that
Right.
kind of sit in between typically.
But are the banks involved in those initiatives?
Yeah,
in that
those
conversation?
technology vendors have agreements with the different banks. But I mean, one thing we're doing that that anyone who's self-employed in the audience would understand, self-employed is always nasty, right? It's much more difficult to underwrite someone who's self-employed. Nima mentioned the difficulties of getting IRS information, particularly around tax season. Also, for those who are students of tax returns, they're actually not that easy to understand, and they don't always tie to cash, which is just a peril of accounting. So the reality is, for people who are self-employed, rather than paging through reams of tax returns electronically and then verifying them with the IRS that the returns you received were actually the ones that were filed, which is a form of fraud. Probably the most common mortgage fraud is with self-employed, because it's kind of hard to fake a property. It's, that's the income fraud is the most common fraud. And so the point is, we're trying to use bank account cash flow to underwrite self-employed borrowers without asking for tax returns, rather than trying to get a static view of the business. We would say, let's just look at the activity in the primary checking for the past year of this consultant, this 1099 worker,
Right.
this Uber driver who also consults on the side and does legal, whatever they do. Let's just look at the cash, and can we underwrite there? The problem is, as we all know, mortgages, there's an ability to repay standard, which has also been mentioned. Like that's the big thing with mortgages, that you can't just do whatever you want, because there's a set of rules, that non-banks are, as you mentioned, are more subject to, right? We don't have the preemption over certain regulations, and as a result, we have to follow certain things, ability to repay standards all the time. And so we can't just say, well, we think the income is this, and we think this person's going to pay it back. That loan could come back to us, and the customer could sue us.
Well, and I think the key consumer insight in that too is that what we see is when we talk to our clients about the experience, they appreciate that they can import that data and be able to get decisions made on it, and they're not chasing bank statements and other things later on and trying to send us documents and things. The group that says, thank you, we don't want to have to go find that stuff anymore, is bigger than the group who says, I'm not comfortable doing that, and it keeps getting bigger every month we're in market.
And is that because the group that likes the place to where this market is headed is just comprised of younger people. Have you seen an age difference there? And is it those coming into the market as like first-time home buyers that are much more into this and more comfortable with the digitization of mortgages, or is it something else?
I think it's something else because we've seen adoption across the age range and across demographics. It's really, I think everybody expects that they can pull out their phone and amazing things can happen with the push of a button, whether it's getting a car or getting an Airbnb or whatever it may be.
Instant gratification.
That's the expectation. And so the mortgage industry has to live up to that expectation too. And the experiences we deliver have to be that easy. And so the way you do that is to build experiences on top of data and other things to make it easier for the client. I mean, the key insight we see all the time is that people are actually fairly comfortable sharing their data. What they're hung up on is they don't want to share their username and password,
right?
Because they've been told their whole life not to.
So how does one get around that?
So really it becomes a thing where people are willing to do that if there's a benefit to them. And so they know, hey, it's 10 o'clock at night and I'm on my phone and I want to see what my mortgage options are because there's something happening in my life and I really need to refi.
10 o'clock at night, do you know where your mortgage is?
If they want to answer that type of question, they're more comfortable doing it.
Yeah. I mean, and also there is a trust with the financial institutions that some people will have and say, look, I know you're using it because you're going to give me a lot of money if I'm able to give this to you. And so I think that there's a belief that their friend got funded by whether it's Rocket or it's SoFi or whoever it is, and hey, if I do these steps, maybe I'll get that money.
But taking the other side of this whole thing, obviously, given everything that's been going on in recent years with data breaches and just the sort of, the system is not as sound, right, as everybody would want it to be in terms of you could give your username password to your mortgage lender, but what happens if that mortgage lender's data system, right, gets breached and that information becomes compromised? So as a consumer, you're thinking about, well, not only am I hoping that nothing goes wrong with my bank system, right, where my information is, but I'm now choosing to give it to a mortgage lender, non-bank lender, right, and is that going to be okay? So there's some of that, those questions about peace of mind, and not only peace of mind, but in reality, like you're now increasing your chances just by giving your data to another firm that something could go wrong with it.
Well, I'd say information security is a technology problem. You're going to be giving that data because they need to calculate ability to repay. You have to give that data to get the mortgage. And so, I would say one, solving the security is something that is relatively important, and all the good companies in this space spend a lot of time and money building that as a core part of their business. And two, for the consumers who don't want to, he said a lot want to, we have 70+%, in some cases 80% of consumers opting in to do that. There are still the 20% who say, you know what, I don't trust doing that. And then the third thing I would say is as the infrastructure gets better, it's moving away quickly from username password. I would say you could expect passwords to be gone in 10 years.
And then how would that work? So if the loan applicant isn't giving you that information, how do you get in? How do you see that?
Well, the password as a concept is going to be extinct.
And why do you, what's the basis for that? Why do you say that?
Because there are better forms of authentication that are harder to breach, like two-factor auth with biometric authentication, those kinds of things where you're not necessarily relying on a password at all. And those kinds of things are becoming more prevalent, and in some cases, I think are probably, as modern systems are being built, are the way that people are building modern fintech companies in the crowd here. A lot of the fintechs here aren't having passwords as part of their applications.
Is that something that Blend is involved in at all in terms of the removal of the password being a necessity?
We are a huge proponent and moving quickly in that direction, going towards things like biometrics when possible. When it's not possible, moving to other forms of authentication that are even stronger, I think, in some cases.
So are there any mortgage lenders now that are doing this, that are using biometrics as opposed to
there are some.
Yeah, mortgage isn't going to lead with that.
I would say the banks themselves are moving. You can see in some of your banking
Chase
apps, you can already authenticate with your fingerprint instead of a password, as an example.
Right.
And that's not even the most secure. I think that there are other more secure things over time that will come out. But I would say, I think at a high level, the things that we see now is that it's really high. It's about $8,800 to process one loan.
$8,800.
$8,800. of which 5,000 plus are human processing costs. Essentially, it's manual.
Think about that, right? I mean, average
5,000
mortgage, 250,000. It's a pretty big cost.
Hundreds of hours.
So as technology begins to eliminate, right, that's the goal, right, to eliminate some of those costs, the time-consuming aspect of getting a mortgage, doesn't that also raise questions about employment?
I would say, definitely, I think.
Loss of jobs in the sector?
A lot of the jobs in the sector will be more around the counseling of the customer and making sure they know what they're getting into and helping them with the loan options, helping them with the process of working with their realtor to do the things the right way, and less about copying information from this system into information and from this system, or information off of this piece of paper into information in this system. And I think it's two ways, right? It both hurts, it's both complex and expensive, but it's also opaque. Opaque to the consumer, opaque to the lender, opaque to the investor. And so as costs come down and transparency goes up, I think that there's an incredible number of people who are affected by the cost. Right? It's not just the lender. A lot of those costs are,
They get passed on to the borrower.
You can't be making unprofitable products. If you make unprofitable products for too long, you can be a loss leader, but at some point you're just going to lose.
Mortgage is a very competitive industry.
Right.
So costs.
That's the understatement.
I mean, it's a competitive industry, right? I mean, especially when you have Fannie Mae and Freddie Mac and the GSE, and Ginnie Mae buying, they're very equalizing. They buy everybody's mortgages at the same price, just dependent on what rate they're charging. So it's up to the lender to figure out what rate they want to charge. And as soon as a lender can lower their rate because their costs are lower and gain market share, they will. So you should assume that these kinds of savings are going to be passed on to the consumer very quickly in mortgage.
And I would say
plus the transparency to the consumer around the process and having it be easier and having lower friction for the consumer means more people will at least try to apply. Now, they might not get approved, but at least having people who are aware. I was probably eligible for a mortgage 5 years ago, 6 years ago, based on basic understanding now of the space. Pre-blend, I didn't have that. And I just didn't do it. Why? Because the first lender I talked to asked me to fax them things. And I said, you know what? I just don't really want to do this.
You just found that too time-consuming, too much of an effort.
I had no idea what was coming. They said it was going to be a lengthy process, an expensive process, and I just said, you know what? I'll just rent. I live in San Francisco now. Of course, San Francisco rents were high, and the house of prices have gone up 50%. So I look like an idiot. But that's because it was a really opaque process to me. And so as people get more comfortable with the idea of this process, because it's better and it's more transparent and lower friction, at least more people will apply and try to get it. And I think that'll be good because
you think that's a certainty pretty much? Because that's one of the things that I've been thinking about, which is that, okay, so things are becoming easier on the tech side. Does that mean that we'd see people trying to refi, let's say, more often than they are, the serial refinancers? Or does that mean that people, like in your example, who were sitting on the sidelines, it's too much work, I don't know, I'll just stay as a renter for now, might take that leap? And if so, what evidence do we have for that?
Yeah, I think we're definitely seeing it today with our client base. What's happening is people now have tools to make good decisions, and so they can choose to make changes to their mortgage or choose to buy a home when maybe they wouldn't have before. So in Nima's example, he
I would have
stops.
been a great Rocket mortgage customer.
You would have. He stops because of needing to fax, right? So as people understand what the tools are that are available out there to them, they'll make better decisions, different decisions, and I think we'll have a more financially educated, financially savvy consumer in America when it comes to mortgages.
Well,
yeah, and a broader variety of products, because you're going to have more data around customers. You're going to have 8.5-year products probably at some point, 8.25-year products. And so, you'll have that product flexibility as a consumer, which is important because everyone's situation is slightly different. You'll have, I think, better risk understanding of the GSEs, of Fannie and Freddie, being able to look at this file and really understand it. And I think that the cost going lower for the consumer, as well as the transparency, it's a certainty.
On that note, we are wrapping up. We can talk about mortgages forever. Somehow 40 minutes have already gone by. And I look forward to having this conversation a couple years from now. Again, and hopefully we'll be way more advanced than where we're at now. So guys, thank you. Thanks everyone for joining us.
Thank you.